Welcome back to the Japan FinTech Observer. Get ready for a quick hit of the latest news in Japanese finance and fintech. We're diving into the headlines, breaking down the trends, and leaving you with the insights you need to stay ahead of the curve. Let's go.
Today, all eyes are again on Tokyo. If you thought the push for corporate governance reform in Japan was slowing down, think again. We have a major showdown developing involving one of the biggest names in the industrial world, Toyota Industries Corporation, or TICO. The heavyweight activist investor Elliott Investment Management has just released a scathing public letter to shareholders, and the message? It's loud and it is clear. Do not tender. Here is the situation. Toyota Fudosan, a subsidiary within the Toyota Group, has put a revised tender offer on the table to buy out shares of Toyota Industries at 18,800 yen per share. Now, usually, a tender offer is a chance to cash out. But Elliott, who describes themselves as the largest minority investor in the company, is slamming the brakes. They are calling this offer wholly inadequate and a coercive transaction that benefits the Toyota Group at the expense of independent shareholders. Let's dig into the valuation, because the gap here is staggering. The offer is 18,800 yen. But Elliott's analysis pegs the net asset value, the true intrinsic value of the company, at 26,134 yen per share. That is nearly a 40% premium over what is currently being offered. So, where is this hidden value coming from? According to Elliott, TICO isn't just an industrial company. It's a vault of financial assets. 2/3 of TICO's intrinsic value comes from minority stakes it holds in other publicly traded companies, including Toyota Motor Corporation itself. Here is the kicker. Since the original tender offer was pre-announced back in June 2025, the value of those public stakes has surged by over 40%. The Japanese market has rallied. Yet, the revised offer price has barely budged to reflect that reality. Elliott argues that if you accept this deal, you are essentially handing over TICO's world-leading forklift business, the number one player globally with 28% market share, for a valuation of less than 1x EBITDA. In financial terms, that is practically giving the operating business away for free. But this letter goes beyond just the price tag. It attacks the process. Elliott calls the governance surrounding this deal deeply flawed. They point out that the special committee advising on the deal urged the buyer to substantially increase the price. In response, Toyota Fudosan raised it by a cosmetic 200 yen. Furthermore, Elliott is raising a red flag on the majority of minority condition. This is supposed to protect independent shareholders, requiring a majority of them to agree for the deal to go through. But Elliott points out a loophole. The threshold is set at a level where only 42% of non-Toyota Group shareholders need to tender. They argue this isn't a true majority protection. It's a low bar designed to squeeze minorities out. So what is the alternative? Is Elliott just complaining, or do they have a plan? They have a plan. They're calling it the Standalone Plan. Elliott believes that if TICO rejects this offer, unwinds its cross-shareholdings, and stops over-investing in its low-return automotive division, the stock could be worth more than 40,000 yen per share by 2028. That is more than double the current tender offer. This is a fork-in-the-road moment, not just for Toyota Industries, but for the credibility of Japan's capital markets. Elliott warns that allowing a powerful parent company to squeeze out minorities at a discount would be an irreversible setback for corporate governance in Japan. For now, Elliott is holding on to their shares, and they are urging every other independent shareholder to do the same. We will be watching the ticker closely to see if the market listens. Until next time, on the Japan FinTech Observer, where we are cutting through the noise in Japanese finance and fintech.